Hello, everyone. I hope you're doing well. I wanted to talk to you today about relative pricing and some of the ways that I manage risk and implement investment strategies. Uh, and I'll show you in a moment what I mean by relative pricing. But firstly, I would say that this is a video that I'm making primarily for my clients, so I can visualize some of the strategies I use and this particular recommendation. So if you're not a client, please be aware this is not investment advice and I do not know your personal circumstances, and I'm presenting this as an educational tool only. Reach out if you want to have a private chat about that. But let's jump into what we're looking at here. So I've picked the 15th of August and sorry, the 14th of August, and I'll show you in a moment what I mean. We're looking at the Australian stock market, the ASX 200 or the XJO, which is the code. And I've picked the 14th of August. I'll show you why in a moment. Uh, the market is up about 1% over that time frame. So what's that? About 6 months or so. September, October, November, December, January. About 6 months. I should have counted that before I started the video. But what's happened is the banks, or the mining companies especially, but in the last few weeks, the miners dominate our index, and they have massively outperformed. So if we look at a ETF that tracks the mining index over that time frame, and let me just make sure it's lining up with that date again, we can see that OZR, which is an ETF that tracks the Australian mining index, the Australian miners, is up 29%, keeping in mind that it makes up a chunk of the Australian market. So if we took the miners out of the index, you'd probably find the Australian index might be down 3, 4, 5%. I don't know how to calculate the math on that. If anyone does, please let me know. I guess I'd have to manually work out the market cap of all the miners. But so firstly, we've seen the miners are up, but then the banks. If we add the bank ETF, OZF, which tracks Australian financials, that's up 5.6%. So we can see the miners massively outperformed. The banks have relatively outperformed, especially over the last couple of weeks. The massive profits from the real estate mega hyper bubble, the bubble continues to be fueled. So what I'm looking at is for my clients, we have broader index exposure. So we have roughly, 15 to 20% allocated to the Australian stock market. It hit a record high yesterday. The miners have massively outperformed, but the banks and miners are such a big chunk of the index and they've outperformed. But if we look at the rest of the market, the Australian market, and I'm going to show you this ETF OZXX. Again, not recommending you buy or sell any of these, just showing for educational purposes. If we turn that on, we can see it is down 13.6% over that same time period. What that means is this fund here, the green line, this is a fund that doesn't own Australian banks and doesn't own Australian miners. They've excluded banks and miners from the fund, and I believe real estate investment trusts as well. So what we can see is that the rest of the market is doing pretty poorly, down 13% over that 6 month time period. So I look at this and go, okay, well, the miners hit all-time record highs. They've had a massive run. They've massively outperformed. The Australian market hit a record high, but a big slice of the market is not doing so well. So I look at this and go, okay, well, I want to allocate more to this sector. I want to get out of the miners and I want to have lower exposure to the banks after they've outperformed. And I want to switch my Australian stock market exposure to sectors of the Australian market that are cheaper and have underperformed over the past 6 months. Now, some of you might say this is where I'm going to. So this is an example of relative pricing. We can see it's probably not a bad time to sell some miners and buy some non-mining Australian shares. But what I'm trying to do is eliminate guesswork because some of you might say, well, John, look how well the miners have done. Why would I want to sell my miners? I don't care if they're at a record high, which I think is an appropriate time to sell. I don't care that they've outperformed. I think they're going to keep going higher. That is what I would call guesswork. You may very well be correct, but you don't have a crystal ball and you don't know what the future holds. So you don't know if the miners are going to keep going up. I'm trying to eliminate as much guesswork as I can when I'm managing portfolios for clients, managing risk. I mostly manage superannuation accounts, so we're not day trading, we're not doing anything too risky, we're not making big bets. So what I would say is I'm looking here at data, and what I can see is that the rest of the market, the non-miners, are over the past 6 months 43% cheaper, or roughly 40%, maybe 39% cheaper than the miners. So I'm not making a prediction or doing any guesswork. I'm not saying that the section of the Australian market that isn't banks and miners is definitely going to go up and miners are definitely going to go down. I don't know that. I don't know the future. What I do know is math and data. I could see that the miners have gone up 29% over the past 6 months, while the non-banking and non-mining sector of the Australian market is down 13.6%. That mathematically makes sense to me that I should sorry, there's some noise in the background there. That mathematically makes sense to me that I should be reducing allocation to the miners and increasing allocation to the extent, however much I want to have in the Australian market, keeping in mind that I prefer to structure globally diverse portfolios, international stocks, bonds, government and corporate bonds, commodities, real estate funds, etc. But to the extent that you've got Australian stock market allocation, I would want to shift from the miners and shift down to the cheaper areas of the market. So for me, what that means is, selling the generic index funds or selling any mining funds, taking the win, and then looking at either switching into something like, again, not making a recommendation here to anyone just watching out there in the world, but for my clients, I'm probably going to recommend that some of us switch from our generic index funds that are heavily weighted to banks and miners and switch into something like OZXX or GMVW, which is an equal weight ETF with leverage. That one is also down 12%. It does have some allocation to banks and miners, but equally weighted, so the allocation isn't as extreme or as concentrated. And the reason I might consider GMVW is because that fund is leveraged. That means if I'm selling, say $20,000 or $30,000 worth of, just an Australian index fund to replicate that same Australian share market exposure, I don't have to buy as much. I might sell 30 grand of the generic index fund or the safer income fund and only have to buy 15 grand of GMVW because it's leveraged. So 15 grand of that equals, 30 to 45 grand exposure, depending on how it's weighted. It does vary a little bit in the weighting. And then that frees up some cash to do something else. Maybe I can put that in a high income, bond-like fund or something like that, just to balance risk, taking some profits, taking some cash off the table when the Australian market has hit a record high, and then just waiting a little bit to buy that second parcel. So this would be an example of what I call, using relative pricing rather than sitting there and guess and trying to go, well, which investments are going to go up and which investments are going to go down. I see too much of that from people online and sometimes from clients. This is not me making a prediction. This is just me looking at the data and going, this part of the market is 35 to 40% cheaper than this part of the Australian market over a 6-month time frame. That seems like a pretty extreme divergence, and it makes sense to switch some allocation from the area of the market that's done. Obviously, you want to stay allocated to the Australian market a little bit. You don't want to be just sitting in cash, and so makes sense to take some money from the area of the market that's done very well and shifting it to the area of the market that is relatively underperformed, just to manage risk, balance allocations, rather than trying to predict which ones are going to be the winners and losers. So I hope that was somewhat informative, and reach out if you'd like to talk about it further. Cheers.